Our session today will be on ratio analysis. So I'm quick to explaining really what financial statement analysis is all about. So financial statement analysis just helps business owners and other users of financial accounting information to provide them with better information about the key factors for decision making. So generally, the purpose of financial statement analysis is A, to use financial statements to evaluate an organization's financial performance. B, to have means of comparing across time in terms of within the company, that is intra basis. Secondly, between companies or subsidiary companies, we call that intercompany basis of analysis, and against industry averages, the benchmarks. Financial statement analysis also is used to help apply the analytical tools and techniques to financial statements, obtaining information that is useful for decision making. So, what does financial statement analysis involve? It involves analyzing information to provide information about the organization's past performance, present, and the future performance. It's there to assess an organization's ability to earning to solvency. It also provides information on business survival. So there are two key um, types of analysis that will appeal to survival, and these are analysis to do with the profitability and solvency. So profitability is important to a business because the business should be able to generate excess revenues above the expenses. So solvency, on the other hand, looks at the ability that a firm or business has in meeting its debt obligations. So financial statement analysis will look at the internal and external factors. The internal factors are there to ensure that the objectives and strategic plan of the company is met, whereas external factors are those that look at the macroeconomic factors and industry factors that affect the operations of the business. Generally, these will give a broader picture of the performance of the business. So we must perform effective financial statement analysis to ensure that you are aware of the business strategy and objectives, and you provide an annual report like other documents about this business in terms of performance. So under industry analysis just helps you compare with other players in the industry. So we use two tools for financial statement analysis: financial statement or financial ratio analysis and comparative financial statement analysis. The comparative financial statement analysis basically uses the vertical and the horizontal analysis, or the trend analysis against this vertical analysis. All right. So this is the way analysis is done in two ways. Now, financial ratio analysis is the most basic tool that we use when measuring a firm's liquidity, profitability. So financial statement analysis or ratio analysis, the ratio simply or compared value to the other. So under ratio analysis, we use this tool for measuring the liquidity, profitability, the reliance on debt, the effectiveness of the use of management resources. So this makes what we call the liquidity ratios. This is what makes what we call the profitability ratios. This is what looks at the solvency ratios and efficiency ratios. So all these have a role. So financial statement analysis basically involves us calculating ratios using one data or two or more financial statements expressed as relationships. So financial ratios are into five main categories. We have number one, the liquidity ratios. Number one, we have the liquidity ratios. So liquidity ratios show or gauge a firm's ability to meet its short-term obligations. Profitability ratios show the firm's ability to make excess revenues over expenses. They gauge a firm's profitability based on the sales or turnover and investment analysis, investment of the assets. So we also have efficiency ratios. What are the efficiency ratios? These are simply ratios that talk about how efficient operations have been and how assets have been used to generate sales. And we have leverage ratios. What are leverage ratios? Leverage ratios are simply ratios that show the extent of debt financing a company. So if you are too over leveraged, it becomes a problem. If you are too over leveraged, it becomes a problem because if you are too financed by debt, you may end up, uh, it's a problem. So we'll talk about the types of ratios that are there. So we also have investment ratios, which show the performance of the investment. So we know that shareholders are cardinal important owners, custodians of financial accounting information, so they will want to know if the investment has been put to good use. The ratio analysis formulas that we use, you need to master this one. So the liquidity, we have two. We have the current ratio, which is simply current assets divided by the current liabilities. And we have the liquidity ratios of the quick asset test ratio, which is the current assets minus inventory divided by the current liabilities. We also have the cash equivalents, which is the cash ratio. We have cash and cash equivalents over the current liabilities. Okay. So looking at the efficiency ratios, which look at how well the managers are using the assets of the company. So in this case, we have inventory turnover, which looks at how quickly we're able to sell our stock. So it's a cost of goods sold divided by average inventory. We also have the debtors turnover, which looks at how long it takes for us to collect our debts. So it's given by credit sales divided by average account receivable. We also have the total asset turnover. Any questions so far before I proceed? Any questions so far? So I'm trying to take you through all this so that you are able to appreciate the interpretation because you need to understand this for you to interpret. All right, so these are our ratios that we're looking at. So we also have the profitability ratios. They look at the gross profit margin, how we are. So we have what we call the gross profit divided by the revenues. The net profit margin is net profit divided by the revenues or sales. And we have the return on equity, which is simply net profit divided by average owner's equity. All right, so liquidity ratios. Now, liquidity ratios, they look at short-term funds. Okay, the working capital management is very important because it will signal a firm's ability to meet short-term obligations. So, to evaluate a firm's ability to pay short-term debts as they fall due compared to the current liabilities over time. So, the benchmark for liquidity ratio is on the current ratio, we're looking at the immediate ability of a firm to meet its current debts. So we have a 2 to 1, which is the generally accepted benchmark. So the current ratio is simply given by current assets over current liabilities. We also go to our quick ratio or acid test ratio, current assets minus stock over current liabilities. It is more rigorous than the current ratio. It considers the cash and the receivables. So if we have something less than one, we are depending so much on inventory to um, liquidate our short-term debts. So this one is more accurate than the current ratio because it excludes stocks. It excludes the less liquid assets. So the asset on which losses are most likely to occur in an event of liquidation. So these profitability ratios also in the long run are meaningless if the organization is not profitable. The liquidity is meaningless unless the organization is profitable. So profitability is very important. It refers to our ability to earning more income over expenses. So we have three key areas of focus. On the gross profit, we analyze the trading account, how our sales doing, how are we able to control the expenses that relies on the net profit margin. And also we are assessing the return on the assets or equity. So we can use any of these, return on equity, return on assets, or return on capital employed. All right, so we'll go to profitability ratios. Profitability ratios. Any questions so far? So you notice that there are a lot of formulas that could be there. So you just need to pick those ones that you're able to understand. You may not necessarily need um, to do all the ratios. So profitability ratios, we have the gross profit margin, which is gross profit over sales times 100. Okay, so GPM, gross profit over cost of sales times 100. That's a gross profit margin. So we can compute this other ratios before going to the contributions on sales. So these ones are the profitability ratios. Okay, so we go to profitability. So profitability, we have two main factors that will determine profitability. So competition. So as you do the analysis, not only about the figures, you also need to determine why the results were so. So I'm giving you the issues that you're going to use. So the two factors that determine gross profitability, number one, competition. As the level of competition intensifies, more substitutes become available, which limit a company's ability to raising prices and pass along the prices to increase customers. Okay. Then we have the product mix. So if the proportion of lower price and high volume products increases relative to other price products, then the gross profit will remain the same. So the profitability ratios, we have also the net profit percentage, which is the net profit before income and interest and tax times 100 over sales. So this incorporates all expenses but excludes tax. So a decline in the ratio over time may indicate a margin squeeze, suggesting that productivity improvements may need to be initiated. So the formula, return on assets, is simply net profit over average total assets times 100. So this ratio shows how much money a company has earned and is invested. So quickly, we also have the return on equity, which is simply the net profit over average total equity times 100. So this ratio indicates the amount of the net earnings resulting from the investments in equity. So This can also be profitability and the shareholders ratio because shareholders are interested in this ratio. It shows how much they're earning on their investment. Also, have the return on equity structure. So the return on equity structure, we're looking at the returns from non-operating activities like financial leverage and spread. We also have the return from operating activities that include the return on net operating assets. So we have the profitability, the asset utilization, profitability analysis, and the turnover. So this is the structure that gives you the return on equity structure. But basically, you need to understand those formulas. And we have efficiency ratios, which look or measure how managers use these assets. So asset turnover measures the relative productivity of the company assets, how much they contribute to the sales. So an asset turnover, as it increases, it means there's greater cash flow that is coming from the sales as a result of the assets that we have. So we have the asset turnover, which is a ratio of efficiency of the asset usage to generating our sales. So it measures the management's ability to generate revenues from investments in assets. So generally, if you have higher ratios, it means as follows. So a small investment in the smaller the investment being used to generate sales, it means the more profitable the company is. It also indicates that the firm has less money tied in terms of assets, which for which quarter sales are raised. So a declining ratio may indicate that the firm has overinvested in assets. So you need to understand what it means. All right, so we go to another activity ratio, which is a debtors turnover. It measures the times trade receivables um, are received during the year. So if you have a hard debtors turnover, it means that you have a shorter period between which the sales are made and the cash is collected. So it's better to compare against the industry average. So it's given by credit sales over debtors. Then we also have the creditors turnover, which measures the rate at which a company pays off its creditors. So it may be given by credit purchases over creditors times 360. If you have a higher creditors turnover ratio, it means you have a short time between your credit purchases and payment to our debtors. So this one is compared to the industry average. We also have a stock turnover, which means the number of times inventory is turned over to sales. So the higher stock turnover, it means the shorter period between the sales and selling inventory. So we measure this against the industry. We also have what we call the working capital management ratios. So we have net working capital turnover, which is sales over current assets and current liabilities. So it shows how efficient our working capital employed is. Okay, so now I'll share these notes with you. I've already shared them. Then we also have the gearing ratio. It measures the percentage of capital employed that is financed by debt. So a higher gearing ratio, it means a higher dependence on borrowing and higher level of financial risk. So if a lower gearing, we have higher dependence on equity financing. So here are the formulas for gearing. We have total debt to total assets ratio. We just divide our total debt divided by total assets times 100. We have debt to equity ratio. We divide the debt of our total equity times 100. And we also have the time, which is the times interest earned. We have earnings before interest and tax over interest. So it measures the extent to which our income can decline before the firm is able to meet its annual interest costs. So usually, banks are interested in this ratio. So it measures it's measured by bankers the firm's ability to pay their liabilities. Normally, it should be above 2. Then we also have market test ratios. Okay, it also has market test ratios. This look at how our stock is performing. Looks at how our stock is performing. So these are the ratios. So we'll go to our example. We're looking at Zeni. It is a company that is dealing with retail practice plastic products. It needs to be analyzed and investors considering purchasing shares there. But they've given us our statements to analyze for them. So this is a statement of financial performance of the year for 2010 and 2011. And this is our balance sheet. Okay, so we're asked to analyze and make a report. This is our cash flow statement. So the additional information we have is that purchases for the year were 2 million and general prospects for major industries for which Zitandizeni is involved look good with the forecast of oil set to reduce the cost of production and the world demand for plastic is remaining strong. So these are the benchmarks. Gross profit margin 25%, net profit margin 7%, the inventory turnover 6 times, debt to equity ratio 0.6 to 1, return on assets 12%, and return on equity. So all our performances must be based on the benchmarks. All right, so these are the two important statements that we must have in mind. So we have the what? The financial statement, which is there. Okay, this is our income statement in short. Then we also have our balance sheet, which is here. So we have these figures in mind. We also have our cash flow statement. So let me put them on one page so that we don't go back and forth here. Okay. So which ratio are we going to use now? We're calculating the current ratios. Which ratios? Current ratio, who remembers the current ratio? Okay, so let me open this financial statement when it's on.
Current ratio.
Okay, so here are the two ratios. So now we're being asked to calculate. Number one, requires to use ratios to evaluate the performance and write a report. So because the liquidity ratios, we have the current ratio and the asset test ratio. So liquidity ratios, we remember that it is what? Current assets over current liabilities, isn't it? So what are our current assets in
Yes.
here?
We have bank,
The total current
accountable
assets.
receivable,
Yes, what are the total current assets here? So current ratio is what? Current assets over what?
current assets over current liabilities.
Yes. So you need to do for each of these years. Now, current assets. So we're looking at the total current assets here over there. The total current
Excellent.
liabilities. Whereas the current liabilities? Current liabilities are here. Similarly here, over here. All together. So
Yes.
fine.
Yes.
Good limits.
So here, 500 over 320, 622 over uh, 360. Okay. So this is our 2020, 2010 and 2021. Then what's the difference with the current acid test ratio? We remove the component of what? Stock. So we get the same total, but we remove inventory from this figure. So we subtract 500 minus 300, 600 minus 370, then we divide by the same uh, current assets. So this is why we are getting the following. Okay, the 500 minus 300 we get 274 over the same current liabilities. The 600 we remove the inventory over that. So remember the benchmark for current ratio you're analyzing is 2 to 1. We are never given there. Of course, about then here it is 1 to 1. So are we together on the computation of the current ratio?
Yes.
Yes.
Right. So we also go to um, the second ratio, which is under the asset management ratios or efficiency ratio. So we have the asset turnover, which is sales over total assets. So where do we find the sales?
Hello.
Yes, please.
Sorry, kindly just go through the acid test ratio. My network skipped.
The asset test ratio is simply the current assets minus the stock. It's the same formula, except that here we're just simply removing what? We're simply
The
removing
inventory.
the inventory altogether.
Yes.
So we subtracted. So our current assets were 574 minus the inventory. When you check our statement here, our inventory was 300. So 500 minus 300, we get that. 622 minus 7, 370, we get that. So this is why and where these computations are coming from. Okay, is that clear?
Very
Yes.
clear.
All right. Then when we go to asset management, it is sales over total assets. So where do we find the sales and where do we find the total assets? So the sales are in the what? Income statement. So the total assets here we have current assets plus fixed assets. This is 1020. Then this is 1061. All right. Then what are the sales for the first year? The sales here are 2,200. And here the sales are 2,600. So we divide this by the total assets. So this is where we're getting it. Okay. 2,000, 2240 and 26 over the total assets. Are we together?
Yes.
Yes.
So what are the uses of the asset turnover? It measures how much assets contribute to what? To the sales. Okay.
Okay.
Interpretation. Then we also have the creditors turnover, debtor turnover, and stock turnover. So it says the debtor turnover looks at how long we pay our Congolese. Creditors turnover looks at how long we get to pay our debt, how much our debtors pay us. Then stock turnover looks at how long it takes for us to what? To sell off our stock. Now you need to realize that as you're measuring that, you must be cognizant of the fact that your stock also shouldn't finish too fast. Otherwise, you may end up having what is called a stock out cost. All right, if the stocks finish too fast, it's a problem. Okay, so you must be within range. So also you must analyze this in terms of how long we collect our money may sometimes determine how much we pay our Congolese. So it is important that we don't take too long. Sometimes our creditors may get worried. Okay, so this is an important um, figure or picture that we must have in mind. Is that clear?
Yes.
So the formula for data turnover is credit sales over debtors. So we already find the credit sales and we already find the debtors. So we go to our balance sheet, okay, and our sales. Our sales is just from the sales itself, okay, 2,200, which we found here, 2,240. This is our sales, 2,600. Then we go to our debtors, which is account receivable for 2010 and 2012. So this is what? 240 and 210. So I'm showing you where they are because sometimes 240 and 210, you have a problem. Remember, the bigger the turnover, the shorter the period. So this is showing which one is performing better and which one is performing bad. From the notes, I explained all that. All right, can we proceed? Then we go to the asset management or activity ratios, okay, which is simply trade creditors times 360. So you can multiply by time. So you look at the number of days. So we're looking at how long it would take for us to pay our debt here. Took 45 in 2010 and took 49. So it took longer. So you need to check why did we take longer on the analysis. In asset management, the average collection period, we look at the length of time. So it is account received data over net sales and 365. So here we took 39 days and here we took 29 days. All right. So this is on how we calculate the ratios. Okay. So I'll send you these notes so that you go through, then we'll look at the paper later on. This is the paper you need to look at. So we're ending here. I have another class. So please look at the 2018 paper, question number 1. Thank you so much for your time. Have a good day.